And go ahead and start broadcasting, Robert. Hey, good morning, everybody, and welcome to the Mortgage Coach Friday Mastermind. Every Friday, we are here to bring value to everybody in the Mortgage Coach community. I'm going to go ahead and start the webinar. So guys, we have an amazing all-star guest. We've got Clayton Collins, the editor and founder, CEO of Housing Wire. I learned that you were not the founder last time, but that was a cool story, Clayton. If you guys don't know Clayton, listen to that first interview and follow Housing Wire. Any opening thoughts, Clayton, before we go around the circle of who's here?
No, thrilled to be here. Like every week over the last 6 months, there's been a lot of new developments, a lot happening in the mortgage industry, negative data, positive data. So a lot to talk about, and I'm excited to kind of couple the headlines with Dan's analysis and overview of the market. So cool format today.
Love it. And I have my wingman and co-host, who I have not had for several weeks. What's up, Todd Bookspan?
Hey, it's so good to be here. You know, did the Bookspan family road trip, towing a 30-foot trailer from Phoenix to NYC and back via almost 6,000 miles of driving, and it was a blast. So I've missed you as well.
Well, miss you. Good to have you back, bro. Help me have a great collaborative conversation today. And for the first 30 minutes of this call, we have the one and only Renee Rodriguez, the coach and the trainer to leaders. What's up, Renee?
What's up, guys? I heard that you had Clayton and Dan on here, so I figured I knew I had to change my schedule and just be a fly on the wall and watch. So I'm excited.
Stop it.
So serious.
Thank you.
All right, guys. Before I bring on Dan Rawitch and we get a market forecast and we get an update, want to do a little bit of just share some big news in Mortgage Coach land. So I'm coming live to you from Syracuse, New York. I just released my youngest son into the wild of Syracuse University. So it's been a fun week here being a tourist and being a dad. But we hit two really cool milestones in Mortgage Coach land. One, we hit 10,000 subscribers of our Facebook group. So for anybody and everybody that gives this channel their attention, whether you never comment, you never like anything, you just check it out, you take ideas and take action. Thank you. For those of you that do engage and you like things, you comment on things, I give you a double thank you. But at the end of the day, it's all about action. If you do come to this group and you get ideas and you don't put them into action, I want to push you. That's why we do this group, is to help you guys be more valuable to the families that you serve and to change how people get into debt in America. Be an advice-based loan officer. Just because you could close loans on time and you have great rates, that's great. That's a transaction loan officer. We want to push you to be an advice-based mortgage professional. Also, we hit an important milestone in our YouTube channel, 11,000 subscribers. Super proud of that. A lot of impact, millions of minutes of consumption of video content on our YouTube channel. And just thank you. Thank you for tuning in. And a big, huge thank you for everyone that makes time for me to interview them and share your secrets, your best practices, and your success story. So thank you. So with that said, this call is about Clayton and Dan. We're going to open it up for the first half, an economic update, an interest rate forecast through the end of the year, mastermind format, Dan. So if you could give Clayton a chance to give feedback on that. And one more opening comment. In my mind, Dan Rawitch is someone that I have trusted for more than a decade on what's happening in markets. He's been a thought leader in the Mortgage Coach community. Dan, how many years has it been? It's been more than 10 years. Is it 15?
Oh, 8. So I think 12 years. Yeah.
So for 12 years, he's been doing a daily update. And so Dan, this Mortgage Coach community, the YouTube channel, the Facebook group, there would not be as many people tuning into it and getting value from it if it wasn't for the daily value you bring, bro. So thank you. And with that said, I hand it off to you to bring it home, brother.
Thanks, Dave. And as always, let me know if I'm going too slow. So guys, I've got tons of slides. Oh, I got to share my screen. Sorry. Just hit the wrong button. Okay, here we go. And this one. Okay, so I'm going to go fast because I've got a lot of slides as usual. And I think Dave will be able to make these slides available, yes? I'll take that as a yes.
Well, we will guys, we will put these slides in the file section of our Facebook group, so they'll be uploaded into the file section. So when you're looking at Facebook, look for files, and you'll have Market Mentor Forecast August 21, 2020. Check it out, download it, and use it.
Yeah, and my goal is, you know, to be a market mentor to you. So you take whatever I have to offer, slides, whatever, make them yours, and you become a market mentor to your clients. All right, so I want to start with some quick housing slides. Clayton's clearly, you know, more the expert here on this topic, but I just wanted to bring you up to speed on some of the crazy things that are happening. Housing starts hadn't reached over 1 million starts since July of 2007. And then the pandemic comes along. We had slowly been rising, and then we fell back below this 1 million mark. Crazy enough, we talk about a V recovery in the economy. Well, we got it in housing starts. Now, if you think that that's great, it's not great. Look where we were in 05, 06. You know, we hit the highest housing start number we hit was 25 million housing, new homes were started. So we've got a long ways to go for that to get better. And I think the builders are going to keep building, and, you know, clearly I'm bullish on builder stocks. Clayton, anything add to that one?
Yeah, the one, I mean, I think you bring up a good point. That's really not great. It's great progress, but like we're not in a great spot yet. One of the comments that really stood out to me when the National Association of Realtors commented on housing starts was the risk of building supplies and materials really slowing down the progress of this number getting back to those 05, 06 levels. So that's something that we're watching pretty closely. Love seeing the progress, but the scary part is, do supplies and labor slow down this kind of hockey stick trajectory, or do the houses that come to market, are they not affordable and not the stock that the housing industry actually needs?
Yeah, and those are key points. I don't have slides on it, but those have been following me and our members. I talk a lot about commodity prices, and I think they're all about to blow up. So steel, the metals, et cetera, and that's going to come into lumber. And so we could see some home prices inflating, not just because of demand, but because of these supplies required. Okay, and then just inventory. The theme of these next few slides is what is happening in this flee from the urban markets into suburbia and rural, in fact. And so you can see, like San Francisco, this is year-over-year inventory, just hammered. It wasn't just the pandemic. It was the pandemic and all of the civil unrest, rioting, et cetera. It's just driving inventory up in these big cities. So I would just look for some real softening prices in the big cities and a much firmer prices in the urban areas. I'm sure you guys are seeing that as well, Clayton.
Yeah, actually, we're so on theme today, Dan. I wrote a post for our Lending Life newsletter on this topic yesterday of urban, suburban, and rural housing trends. And Redfin had some really interesting data that was actually made perfect sense in terms of basic economic supply demand theory. And the data was showing that supply in the rural areas was down close to 38% year over year. Suburban inventory is down 32% year over year. Urban inventory down 21% year over year, which kind of moves in exact lockstep with home prices in those areas. So rural prices are up 11% year over year. Suburban prices are up 9% year over year, and urban home prices are up close to 7%. So still crazy home price appreciation in all markets, which we know feels good if you're a homeowner, but at that double-digit level in some markets just it isn't healthy or sustainable for a healthy housing economy or affordable housing market. Your new entrant, your first-time home buyers get priced out pretty early, no matter how low interest rates are.
Hey guys, I want to add something to this slide because this just reminds me of the interview that I did with Amber Kovark, where she talks about for every refinance she's doing, she's asking the family, how's the house you're in currently working for you? And make sure you're finding out how families are feeling about their house. A lot of move up, opportunities. If you listen to that interview, and my team edited it, so there's a mortgage coach clip that's about 8 minutes long, where you get to hear her entire interview, you get to hear the entire script of how she's taking refis and she's turning them into listings for agents. And think about it, guys. If you're the loan officer that during that refi conversation creates a move-up opportunity, now you have a listing for an agent and you have a move-up buyer for an agent. So you're serving the family, you're serving agents, and make sure you know how to do the mortgage coach, TCA, move-up conversation. Super important. We'll put a link down below for anyone that wants to check it out.
Great.
Dan, would you mind going a little bit? Would you mind going a little bit deeper on that city proper versus MSA kind of breakout in the trend data? That's really interesting to me, and I haven't seen data presented this way before. Would you mind talking a little bit more about like where historically, if we've seen that breakout between city proper and MSA, and what the exact market condition is that caused that breaking point?
Well, so in just following this, I have not seen really a bifurcation between the two, really ever. You know, it's always been if the city proper markets were hot, the urban markets were hot. Rural will sometimes lag, you know, a lot of markets. But so this breakout's really been, you know, post-pandemic, people don't want to be near other people. And then the civil unrest hit and people just started fleeing the cities. I think this is going to accelerate. I'm a contrarian, and most of you know that. I think it's the only way to really make money in the markets I trade. If you follow the pack, you're late, and you become what's called dumb money. So I see opportunity as this accelerates into, you know, investors being able to buy rentals in cities, because people are going to be fleeing it, and that's the time to get in. I don't know if I answered your question or not, Clayton.
Yeah, no, that does. So do you think, it seems like the one market that isn't bifurcating as quickly in this slide is Miami. Do you think that kind of speaks to the population migration we're seeing from northern metropolitan cities, or does that speak to like just the geographic and housing stock that's currently Miami, which is not nearly as dense as a city as the other 5 on the chart?
That's exactly what I think, and I think that this is opinion, not fact. When I think of Miami, I don't think of it like Los Angeles, Boston, Seattle. It just doesn't feel like a big city to me, you know. And it's a big, huge retirement place. So I don't feel like, and I don't hear about rioting or anything in Miami. It might be existing, but I'm not seeing it or hearing about it.
Interesting.
Okay. And then I'll kind of blow through some of these. So this is the change in sales above list price, urban versus suburban. And it's very subtle here, but you can see that the suburban line is the blue. It's beginning to overtake the urban line. So we're actually seeing more homes in the urban markets selling above list price, which, by the way, is still way down below it was you know, during the pandemic. You can see post-pandemic, homes really started selling over list price, and then they started declining. So slight slowing trend there. We're not seeing it. The opposite had come out in today's existing home sales, new record set. But the price bids are not as aggressive. And keep going. Jump in anytime, Clayton. And this is kind of the same thing, but an opposite glance at it, and that's the listings with price cuts. And you can consistently see in the urban markets, you know, not in the Midwest, because again, I just think that's different than a lot of the, you know, the Western cities. But you can see the trend kind of is the less price cuts are happening in the urban markets than the suburban markets. But it's not a huge difference. Let's see, I think I got blocked. Okay, so this is kind of just inventory changes, urban versus suburban. And remember, urban's the gold line. And so what you can see is the inventory is starting to slowly grow in the urban markets. These are the markets people want to get out of. In the most parts, there is inventory is getting better in these markets, and it's getting worse in the suburban markets. And these all just go to that same point that I think people are wanting to get out of the cities. And so if I'm a loan officer, I'd probably be spending my money marketing in, you know, smaller towns around your bigger cities. That's my 2 cents. Anything to add there, Clayton?
Yeah, I noticed one of the metrics that stood out to me from today's existing home sales data was that unsold inventory sits at 3.1 months compared to 4.2 at the same point last summer. Are you seeing inside of these markets that you break out here, like where are the outliers on that 3.1? Are there any regions that are just significantly less, or where the inventory is starting to build?
Well, you can kind of see here again, it's more, urban stuff. You've got inventory building here in the Northeast much faster, Midwest faster, and I've got us blocked here, and then the West. So it kind of shows you where its inventory is growing a little bit faster in these areas. Still negative from last year, but it's growing. I think this might be my last home sales slide. So this is median price year over year, again, urban versus suburban. And you can see the urban prices are not doing nearly as well as the suburban prices. So probably overmade this point, but I think you get it. The action is going to be moving from the cities into the suburbs, which is opposite. I'm the opposite of millennial. I have 3 millennial children. And, the millennials, all the press was they want to live in the cities. They want to live where the jobs are. Remember that? They wanted to walk to work. They didn't want to commute. It's completely shifted. I mean, I've never seen such a shift in society in just a matter of months. Any comments on that one, Clayton?
I mean, that's what a pandemic recession can do.
Yeah, how about that?
Quickly. I mean, we've been using the term the great acceleration, primarily in reference to technology adoption in the financial services and housing world, but it's also everything else that's being accelerated. Societal trends that would have happened. So like millennials aren't, it's not your college grad anymore. The oldest millennials are 39 now. So like there's a good chunk of millennials that like may have still been living in the city and were preparing to move to the burbs or a rural market or back where they grew up in the coming years. And that decision was accelerated. So now you go down to the generation that's just graduating college, and they're no longer making that decision. That decision is being made for them. The jobs just aren't available in the urban markets, or the urban employers are saying like, hey, you're working remote. So the decision becomes, why would you pay $3,500 to split a 1-bedroom apartment with 3 people if you could live with your parents or back in a smaller town while you start your career? And I think that's the forced decision that's being made right now by that constituency.
You made a good point. A lot of this is about affordability. And, I've been a proponent of remote working most of my career. And one of the companies we launched a year ago, well before the pandemic, all of our employees are remote. And it was a great competitive advantage in hiring people. And then this damn pandemic came along and everybody's remote. So I lost that benefit. But the point is, why would you live in a big city and pay in San Francisco $5,000 a month rent for a 1,200 square foot apartment when you don't have to live there? It doesn't matter where you live. And so I think people are generally wanting to get out of that area, and that will continue. Okay. And this is just sales price growth year over year. And you can see most of it.
Hey, Dan.
Yeah.
Dan, I want to jump in on 2 things. One, Renee Rodriguez, before you jump, I'm going to ask you to come in a few minutes and talk about pre-framing, because a lot of this is Dan's creating great stories, great messages. Colin's going to do the same thing. Before you leave, I want you to just share some Renee Rodriguez's on how to frame these and share these and some of your best practices there. Before I do that, I do want to remind guys in the mortgage business, this pandemic has changed everything. And there are other things happening. When you listen to the interviews that I did with Steve Brown, the former futurist for Intel, internet and its ability to give everybody internet anywhere and everywhere, not only in America, but on the planet. Literally within the next 5 years, you're going to have an incredible quality internet, not just wherever you're at in America, but wherever you're at in the world. And then autonomous cars are coming, and the ability to live further away from your job and work while you drive. So there are some big changes happening that we're going to change American real estate already. It's just what was going to take decades is literally going to take the next 5 years. And a lot of it's happening now. So being a move up specialist, being someone that can do more than a transaction, you can ask a family, what are your hopes? What are your dreams? What are your goals? And then you can help them craft a real estate plan to achieve their dreams. If their dream is living in that small town of Ashland, Oregon, where they could not get the job that they wanted, but it's a lifestyle they want, they can work in Ashland. They can work for Apple in Ashland now. So guys, this is a big deal for mortgage professionals. And I just want you to realize it's not just, hey, what's going to happen over the next year or 2 years? It's not what's happening now. It's what's going to happen over the next decade. Big changes happening, guys. So Renee, I gave you a little warning. We'll bring you back in a few minutes. Dan, a couple more insights.
Okay. Yeah, I was going to say one of my favorite sayings I ever heard from a futurist type of person was, the faster we go, the faster we go. And oh my goodness, I mean, what Dave just said is so true. I remember I got laughed at. One of my friends actually spit his drink out when I said, 10 years from now, most of the cars will be electric. And this was 2012. And in fact, I recently sent him a note. I said, hey, Brian, remember when you laughed at me when I said, you know, the most cars will be electric in 10 years? And he said, no, because I've always laughed at everything you've said. But that actually happened, and it's coming true. And 5G is going to change the world like we've never seen, because that's machines talking to machines. That gets a little scary. So, and then just kind of closing on the housing side here, although everything I say will relate to housing, rents. Oh my goodness, rents are being just squeezed in the cities, and they're growing in the suburbs. This is a major shift. I've never seen one down and the other go up, you know, completely diverging from one another. So I don't know if I'd be advising clients to buy rental properties in big cities right now. I'm a contrarian, but there's a time, you know, to be a contrarian. There's a time to let it play out. So, and again, I don't know if you follow the rental market much, Clayton. If this is what you're seeing.
Yeah, no, this is actually the divergence is interesting, but I actually expected to see a larger drop on some of those suburban rent numbers. It'll be interesting to see how that plays out in the coming months, especially as we see what and if we see another government stimulus package that seems to be most important for the renters. And we kind of see PPP start to expire, which may impact some employers' decisions to retain the current level of staffing. What the strength we've seen in the home ownership market has been incredible, but like everything with COVID, this pandemic is not fair, and it seems to be impacting the folks who rent and the rental market in a much more severe way than the ownership market. I want to come back with you next month and the following month, Dan, and look at that rental number again. I think it's going to grow on the downside.
I totally agree, because this was June. So I think it's already grown quite a bit. This is the most current slide I can get, but I agree.
So Dan, this is a perfect transition point. Why don't you just stop sharing your slides just for like 3 minutes? And Renee, if you could bring some of your leadership to loan officers that are watching this, they have the slides, they want to share some of this content, and they want to position it. And then the term you use in Amplify is frame. Could you just give us a little 3-minute 101 how to frame content like this in a way that's compelling and valuable?
Absolutely. And first of all, I mean, I just love hearing both these guys talk about this, because it's a different world that I live in terms of understanding it. And so it does allow me to take it on from a consumer perspective and say, okay, if I was looking to buy a house and if I was looking to refinance, if I'm a new loan officer, how am I absorbing this information? Because that's really, at the end of the day, it's not just about the data. It's about, am I transferring that data from one person to another? And so the thing that came to me, you wanted me to talk about framing, but I want to talk about actually a specific kind of frame that I think is very powerful for a situation like this, is what we call the contrast frame. And so if you notice, I'm in a different place now as I was before. That creates contrast. I've got a better microphone, even where I was sitting before, creates contrast. And contrast creates attention because it does two things. It creates a little bit of novelty, which triggers norepinephrine dopamine, and then it creates a little bit of tension, saying, well, what happened? I don't know what happened. That creates norepinephrine. Dopamine and norepinephrine create attention. Those are the sort of the formula. So it's novelty and tension. And so when you're able to show those numbers, the only way to make it novel when you're looking at that many numbers is to show contrast. Where were we before? Because the most powerful pieces are, well, let's look at where we were before. He showed us like, wow, we got the V-shaped curve. But then when he brought our attention back to saying, but it's really not that great, because look where we were back then. If you were to, just like a story, build the character of the history, here's how we've been in the past, here's how it is, it gives me a contrast to show how I am now. Because I'm not a pro at this. I don't live in the world that you take for granted knowing so well. I'm a consumer, just wants a house. I want the playground out back. And hopefully I can make some money in this process. I want to start building wealth. When you show me the contrast, before you give me the data and the information of what you're trying to tell me, you got to build the frame through contrast. And the last piece that I would give you is make sure that you tie it down. So it's called framing, give the message, that's the data that you're giving, and then tie it down, which says what this means to you is. And so you've got to, that's the biggest missing piece that I see mortgage professionals miss. They post great data and information. You're lucky enough to have a Dan Rawitch and a Clayton here to give you that data, but you got to translate that data to a consumer or to a realtor or to a financial advisor. And the transitionary language is, okay, so you saw this data, but here's what it means to you. And the more specific you can get on that, the better. Like when I hear Dan say, well, I'm watching these stocks real well, I'm going, okay, watching them. Does that mean buy? Does that mean sell? Or does that mean watch? Like, I don't know what to do. Like Dan knows what it means. But I'm going, I just wrote down steel. I'm like, shit, am I supposed to buy steel? Am I supposed to wait on steel? Lumber? What am I supposed to do? And I'm watching that and I don't know what to do. Now, if he were to say, here's what it means to you guys, go to your investment account, put these on watch. When they hit this, I want you to do X. Now, I know you can't probably say all that kind of information, but that's the level of specificity I'm saying. If you can say, hey guys, now is the time. What this means to you is lock your loan. It might go up or down, but now is a great time. Remember where we were in contrast to before, and you're going to fight over if it's here or there. Guys, don't lose sight. Keep your eye on the ball. Lock it now.
So
Awesome.
Before I hand it back to Dan, I want everybody also to write this down. The data that Dan is sharing is national. Now, he has shown some specific cities, but most of you who tune into this channel, you're a local referral-based mortgage professional. So you're always contrasting national to local, and then the tie down is personal. So now that I've shared some national facts, I've shared some local data, what are your assumptions on what rates are going to do? What are your assumptions on appreciation rates? What are your personal goals? And now when I deliver that, and I deliver it in a highly personalized way, you have attention, you have leadership. You can move the needle with families. And that's why the total cost analysis is so important, is it helps you create that contrast between different options over different periods of time. So Renee, that was awesome. I can tell already we're going to want to clip that into a mortgage coach highlight. So thank you, brother. And
have at it.
You could jump anytime you need to, or you can stay on the whole call.
I do got to bail. Thank you guys. You guys are awesome. See you soon.
Good seeing you, Renee.
Good seeing you. So Dan, you and Clayton have a great rhythm going. Just keep it going.
All right.
I'll tell you when I see your screen again.
Okay.
And community, if you have questions, post them in comments. Myself or Todd Bookspan will do those. And if you're watching the recording of this in YouTube or in our Facebook group and you have questions, post those. We'll make sure they get answered. Let's talk about the Fed.
Okay. Now's where we get a little bit nerdy. So go nerdy with me. The Fed has really killed the concept of free enterprise and in some ways capitalism. The Fed is really dividing wealth and doing all kinds of things I'm opposed to. Again, my spin is never to be a hater. I've presented the Fed for many, many years. Now, granted, the last X amount of months, thank God. I mean, really, I don't know where we'd be without some of the actions they've taken, and I applaud Powell for that. When you see these slides, I think you'll see where my concern's been about the Fed for a long time. So, look, what do you care about? If you're here on this call, you care about where interest rates are going. That is your predominant concern, because there's two things that there's one thing that make home buyers buy, and that's affordable market. When affordability is good, you should get in. I sold my home in 2007 at the very top of the market. I say that not to get a pat on the back or for anybody to tell me I'm smart. One, it's because I'm a contrarian and things were too good. And two, I watched the affordability just get really bad really fast. So affordability is driven by interest rates and housing prices. And if both go up, you're in trouble. If one goes down, one goes up, you're okay. So right now, you're okay because interest rates have been going down, even though housing prices have been going up. But affordability is getting a little bit squeezed. So the whole point here is, does the Fed stimulus, does the Fed driving down Fed funds rate, do those things create inflation? And why do you care about inflation? In my personal opinion, inflation is the only reason on this entire earth that the Fed ever has to raise rates. And they get it wrong every single time. I'll prove this to you in a minute. They raise rates, they drive us into a recession, and then they have to lower rates. And they're always too late to the party, and none of that has ever really controlled inflation. So this first slide here is inflation versus the Fed funds rate. And I don't know how much clearer this could be. You can see as the Fed funds push down rates, supposed to be inflationary, right? Lower rates, hot economy, inflationary. Push down rates, inflation went down. They pushed rates way up. You would think that that would have driven inflation way down. It didn't. Inflation went up. And all this time, the Fed just cannot get inflation to come back up. The scale looks like, wow, but keep in mind, this is 2018. We're now back in the 0.5%, 1% range. So I just want you to be really hyper-focused on, sorry about that little pop-up, hyper-focused on inflation. And inflation also translates into PCE, which is basically the prices that consumers pay for goods. It's a little bit different than inflation. So this is the annual inflation rate from 2010 to 2020. The Fed's target is 2%. They got to get it over 2%. And the reason for that is deflation is the enemy of everything that's good. If you think about what's happened in Japan, the last 20 years, they've called those the lost decades. They've had nothing but deflation. They've had declining birth rates. When I show you interest rates across the world, you'll understand why Germany, Japan, some of these countries have negative interest rates, because they have deflation and they're trying everything to pull out of that deflationary cycle. Imagine having a house payment of $2,000 a month and income of $5,000, and 1 year later your income is $4,500 because of deflation, and your house payment is still $2,000. That's not what you want. You don't want to wake up, go to bed with $10,000 in the bank, wake up next year and have that $10,000, have $9,000 buying power. You hear that in reference to inflation, but deflation is the real killer. Inflation is a good thing if it's moderate. So, Clayton, anything you want to add to this?
Well, I know, or I have a feeling you're about to tie in Fed activity, inflation to your interest rate projections. Before we get there, and we steal some comments from Renee. If I'm in a situation where I'm talking to my realtor partners or potential borrowers and inflation comes up, how do I want to talk about inflation? What's the framing there that makes this information valuable in our day-to-day business or in the audience's day-to-day business of working with consumers on buying or refinancing homes?
Ooh, you stumped me there. That's really good, because I'm not sure how you would take this to the consumer level. The slide's more intended on letting a forecast for the LOs in terms of where I think rates are going. But if I'm a market mentor, I need to help them also bring that down to the consumer level. And I think consumers probably would just be interested in knowing that we need to not care so much about inflation. We need to not be so focused on it, because if our big concern is it going down, and the Fed's probably going to have to keep rates low for a very long time. Now, if I'm buying a home and I'm locking in a rate today, do I care what rates are going to do later? Probably not. If I'm thinking about buying a home, I think that that's an argument maybe for waiting. So I don't know that this really drives down to the consumer level. How about you?
If I'm a homeowner, do I care about the relationship between inflation and home price appreciation?
Sure. Mm-hmm. Except that, and yes, of course, but you know, there's two things inflate things. You have this demand push, and then you have this pull inflation. And one of the themes here later on you'll see is I'm nervous about housing prices, not because of inflation, but because the supply is so bad. It's never been this way, and it's distorting home prices, in my opinion. I don't know that we have a huge increase in demand so much as we have this huge decrease in supply. And I want to see home prices go up because of this overwhelming demand that can't be met by supply, not an underwhelming demand that can't be met by supply. Does that make sense?
Yeah, I mean, we talked about the most recent home purchase data from NAR earlier today briefly, but we just hit publish an article showing median home price jumping 8.5%, breaking 300,000 for the first time at a national level. I mean, that's insane. That's just a lot. That's 8.5% home price appreciation.
Yeah, it's too much. And so one thing I've always been clear, even back in my loan officer days, is look, please don't buy a single family home that you're going to raise your family in because you think it's going to be worth more than 10 years. Buy that home because, and I have I don't have them here, but I have done a whole presentation on rent versus own. Rental prices continue to go up. They never stopped going up even through the recession of 08. Home prices did take a little dip, but if people didn't buy at some point, then their rent just kept going up and up and up and up, and that's not a good thing. Where if you go 12 years, if you would have bought in 08, even if you would have overpaid a little bit, you would have saved, you know, tons of money in rent, and then now you're 12 years into paying down your mortgage. I think the wealth creation should be counted on by the paying down of the mortgage, not some crazy home price appreciation. It's not the right reason to buy, in my opinion. Same thing with rental property. I don't buy rental properties for appreciation. It's the icing on the cake. I buy them for cash flow.
Well, Dan, I don't want to mess up your cadence. So we were just coming off a slide. We were looking at healthy inflation in that 2 to 3% range. But last year, or was it this year, we're looking at 1%. So I want to get you back going on that trajectory.
Okay. All right. Yeah. I'll go a little faster here and just jump in when you want, Clayton. You know, just go or whatever. Just let me know you have something to add.
No need to speed up. Keep going. I like the.
Okay.
I love this.
Okay. I wanted you guys to see that. Look at these inflation numbers back in the 17, 18, 19, 20s. Look what happened during the Great Depression. Deflation became a horrible, horrible thing, and it took a long time to pull out of this. These were dark days. And you know what was happening before all this? Is the Fed was tightening monetary policy. As they tightened monetary policy, we actually created inflation. And then as they started to stimulate us out of the recession, we actually went further into deflation. So once again, the Fed's actions are typically opposite of what you would think. So just a quick reference, as Renee said, you know, where were we and where are we? You can see during deep dark, this is kind of the phase 2 of the recession, how much deflation just really hurt people. But also you can see how bad inflation was. So this is the Fed overreacting, and then this is the Fed overreacting, and then this is a normalized period. And then going into the 70s, this is the time that I lived through. I got in the mortgage business in 78, and I remember these inflation numbers. I remember selling 16% adjustable rate mortgages, and the Fed continues to behave as if this is going to happen again. Once again, if you look at charts, you would see that the Fed was not stimulating here, not at all. I don't have time to get into stagflation, but that's a chance of where we could be heading. So it just kind of uses as a reference. Now look, from 06, it just was non-existent. I mean, the biggest year of inflation was the first half of the year in 06, kind of as we were heading toward the recession. The Fed panicked here, and the Fed started draining the money supply. They started raising interest rates, and lo and behold, they did it. They put us into a recession, and you'll see that on the next slide. And look at today, guys. When did QE2, QE1, all that QE stuff started? It started in about, I think 2014, And the more the Fed stimulated, the lower inflation got. So this is inflation as it relates to Fed funds. And what I want you to notice here is as the Fed raised rates, a recession followed. Fed raised rates, recession followed, and so on. And even right into 2020, Fed started tightening a while ago and helped us come into an inflation. So I just, if a consumer or anybody start talking to you and they're telling you, look, you know, I think these low rates and I think all this Fed stimulus is gonna really create inflation. It's not gonna happen. It's not the reason to make a decision. And then what you can see here is in 2002, the Fed crossed the Rubicon where lowering rates didn't stimulate economic activity anymore. So they used to be able to lower rates, lower rates, lower rates. This is the blue line. We haven't talked much about M2. M2 is just the velocity of money. How much is money spinning around in the economy? Money velocity is what creates inflation. And so you can see as the Fed was dropping rates, fine. And then about in 2000, about the time where the dot-com bubble hit, all of a sudden, the more the Fed pushed down rates here, money velocity just stopped. And so this is where inflation started going down. So the Fed's kind of got a problem in that for every dollar they spend, they used to be able to create a dollar or two of economic activity. Now they have to spend $20 to create a dollar of economic activity. And this just goes back to the stimulus not being inflationary. You know, you've got QE1, QE2, QE3, QE4, and you can see the balance sheet just keeps on growing. And then I'll just bring you back to the slide one more time. Since all these QEs started, oh, I thought this had a date. It does not. But we know that this QE stuff started around 2015, and then you can see inflation was non-existent. And then again, money velocity versus the deficit. The more the Fed puts us into a deficit, the more money stops moving around. So this stimulus is not inflationary, and it certainly doesn't drive the economy. It does the opposite of driving the economy. And just think about in terms of this. If you're, I think I have a, I'm going to skip ahead anyway here. I don't have that. I don't want to get to this one yet. If you have, if you make 100,000 a year and you have 100,000 in debt, are you very much of a consumer at that point? Are you out there aggressively looking for new toys, new tools? Are you buying everything on Amazon? No, because you spend every penny you make. Your debt is equal to your income. So that is the opposite of inflationary, and that does not drive your personal family's economic growth. That's what's happening to the country. The country has more debt than it's had since, I think, the 30s or 40s. And we have so much debt. The debt is a drag on the economy. So the only thing that scares me about inflation, which would scare me about interest rates, is the dollar. Now, this chart is a little bit confusing, but it's inverted. So the green are, what do we have here? Bonds, Fed fund rates, and the red is the green is the Fed fund rates, and the red is inflation. And what you can see here is that as the dollar has gotten trashed, inflation has gotten worse. So we just don't want a real low dollar. Every time the dollar gets too low, inflation gets too high. And the Fed is setting us up for a very, very cheap dollar right now. So that's a little bit scary. Okay, so where's the economy heading? I think that this tells a big story. Most households are worried in the next 5 years about losing their job. Again, I don't go out and spend a bunch of money when I'm thinking about losing my job. That's going to keep rates low. Just some interesting things about what's happening out there that typically may not follow. New York City subway turnstiles is how many people are getting on the subway. They're not. I mean, it's come up a little bit, but this is not a V recovery. This is, and these are New Yorkers. So they're not jumping in their car, I'll tell you that much. So what are they going? Nowhere, or they're walking. I wouldn't get on the subway right now.
It looks like a dramatic version of the home starts chart.
Yeah,
there's a V down here, but it's not back up here.
Exactly. That's exactly right. Man, you guys know this if you read my weekly newsletter. I look at Google Trends for so many things because they really do lead everything. And you can see here that in March of 2020, just before jobless claims went through the roof, people were searching to learn about jobless claims. And now things got better, 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 better. And all of a sudden, Google searches started just dropping. Look at Google searches for unemployment claims were rising while unemployment claims were falling. This number will absolutely pull this number up. So you're going to see the jobless claims number rise. I did this slide before yesterday's jobless claim numbers where we saw that for the first time they stopped dropping. So, and Clayton kind of touched on this, that there's this have and have nots, which is, it's really kind of sad. And that's the homeowners are doing pretty well. And the renters are being hit really hard. It's kind of interesting how this is playing out. So this is the slide I was looking for. This is private debt. How much debt your family holds versus your the GDP, US GDP. So you can see, you know, this is how much debt versus GDP. Now this number doesn't necessarily relate exactly to what you might think. This is as GDP has grown. So basically the value and the income of the nation, how has your debt grown? Your debt should be going down as the nation is growing, right? This is really saying the economy has grown and you're not. So this is also a frightening figure, and it's another concern about the whole wealth divide. The wealthy, this number's going down, and everybody else is going up. I hope that yours is going up.
Now Dan, I know that the axis on there was 200 to 220, 208 to 222. So is this increase as dramatic as it looks in this slide, and have we seen other increases like this in previous decades? I don't want to shout chart crime, but it's zoomed in on a pretty tight part of the axis.
Yeah, no, I think it's a super good question. And yeah, it is. These numbers are, 208 to 220. But anything over 2 starts becoming alarming. And when you see this kind of increase, it's telling us something. All these little jumps are telling us something. So I guess in my opinion, Colin, it's less about the actual number than it is the trend. You know, I look more for trends than the absolute numbers. But you're right, it's not as dramatic as it looks.
What are you anticipating in 2020 there? Because is this ending in 2019 right now?
This takes us right up to the beginning of 2020, and okay. I think it's going to get much worse, just based on jobless claims, etc. So I'm not going to get into the stock market a lot. You guys know it's my favorite topic, but I do want a couple of points here. This is consumer sentiment, the black line. This is how much consumer sentiment dropped. This is not enough for what we have going on. What we have going on is an order of magnitude worse than what happened in 2008 in terms of loss of jobs, corporate income falling. I can't really think of an area where we're not worse off than we were in 2008. But the message here is it rebounded, you had your V, and now we're making a W. And I think this is going to continue its trend back down. But the shocking thing is, look at the S&P. These should not diverge, ever, never, ever. I mean, when consumers feel good, they're buying, stock market goes up. When consumers feel bad, they're hibernating, stock market goes down. This divergence is what's going to cause the next big crash or correction in the stock market. We all know it's coming, we just don't know when. It's another reason. And again, if I want to frame this for a homeowner, I would say I think you'd be happier. You can't give investment advice. I think you might be happier in real estate than in the stock market over the next couple of years. I firmly believe that. Dave, I see your face. You want to add something?
Yeah, well, we got about 10 minutes left, and I have about 5 minutes I want to give to Clayton to talk about a couple topics, or at least one topic. So if you could, in the next 5 minutes, one, net out what you think rates are going to do between now and the end of the year. Also tell everybody how they can become a market mentor and be part of your program. And so we can get into at least one of Clayton's topics.
Awesome. Okay. So I'm just gonna thumb through these super fast. Architectural billings, commercial, I believe that real estate leads economies in and out. I'm not talking residential. I'm talking about commercial. I'm talking about office buildings, apartments. Ouch. Ouch. This is how much money is much less money is being spent on architectural drawings. It has bounced back, but it's still close to where it was in the '08 recession. All right, what does all this mean for rates? So you saw the Fed just said something the other day, the bond market overreacted, and it just tells you how the Fed just still has a little bit too much play here, and we're weighing every word that they say. This is what the yield curve looks like. I don't really have time to get into this much, but what I did want you to see here is this is the yield on the 10-year bond, and you can see by country. Japan just went positive. They've had negative rates for years. Germany, France, Netherlands, Switzerland, all negative rates. And I would say that their economies are probably not worse than ours. So it's interesting that our rates are sitting at 66 bips and they have negative rates. I don't know that we don't want to go there, but the Fed may be forced to take us there. And then we got the Fed buying bonds. I mean, this has never happened before. They were buying corporate bonds at first. And we certainly made some money just buying some of these are called ETFs, electronically traded funds. And so like JNK is a fund that holds junk bonds. The Fed's been buying these things like crazy. So why wouldn't you just buy these things and know the Fed's going to keep you propped up? This is the Fed's way of propping up companies to make sure that they can raise capital to stay alive. Unfortunately, it is feeding this whole new thing that we call zombie companies. They don't even make enough money to service their debt, but they keep releasing debt to survive. And the Fed's buying that debt. This is the difference between stocks going up and bond prices going down. These not supposed to go diverge. They're supposed to go together. Why? Because when stock prices go down, it means the economy is bad. People are scared. And that also means that interest rates are going to go down, that they follow each other. They don't diverge from each other. So what we know is this is not going to come up to meet this. It can't. The economy is too weak. We have too much debt to service, too much drag. This is going to come down to meet this, which in turn is going to push this down further because people are going to panic and it's going to drive rates down further. So I see much lower rates coming and you guys are going to get a heck of a lot busier. So my point here is this is a 30-year fixed rate, this blue line, and this shaded stuff is the refinance index. Look at how high the index was all the way up here when rates were all the way up here. And now rates are all the way down here and the index is still right here. There is no way this should not be and will not end up here. You guys are about half as busy as you're going to be. Unfortunately, I think Clayton's going to talk about this, this whole risk-based premium that was added on by the agencies is really hurting the industry right now, and it's holding us back a bit. But we needed a breather. I'm gonna skip that. Okay, Market Mentor. So I'm really excited about this. We launched this program, I think about 6 months ago. It's grown tremendously. I'm having a lot of fun with it. And the whole premise here is we turn loan officers into market mentors. We help loan officers understand the financial markets, hopefully without getting a headache. That's kind of something I really strive for, is to do the best that I can to speak in simple terms so that you can understand them and help your clients understand them. Not that I need to speak simply for you to understand me, but I'm speaking about concepts you may not have been taught. And then we save you time, help you sound smarter for less than 20 bucks a month. So just a couple quick screenshots. This is me on our website broadcasting, showing things like dark pool activity that most people never even heard the concept about watching dark pools. These are silent trades happening in Europe. We can see where the market's heading. This is our chat room for market mentors. It's open all day long for questions you have. We monitor this. We have a private Facebook page. We broadcast from this twice a day, and get questions and comments, and the members, we're having a lot of fun with it. So normally, we have a weekly newsletter that's 24 bucks a month, and Market Mentor is $17 a month, and we're combining the two of them together for 17 bucks a month for a limited time. So you get 2 to 3 live market updates, you get the monitored chat room, you get the monthly actually now it's weekly newsletter, I do chart classes weekly, so you can help understand where breakouts are. Just before I jumped on this video, in fact, I snuck over and took a couple look. I saw 2 different stocks breaking out. I jumped in and I closed one of them just before because it was up nicely, and the other one's still doing fine. So you always know what I'm watching, and you can kind of jump in alongside. So that's the deal. 17 a month. I think it's a lot of value. And here's a link. Any questions about this, Dave?
We're going to put a link down below. I mean, I'm a customer, and guys, I do it. I mean, 17 bucks a month is nothing. It's the time it saves you. I don't know about what you make an hour. I try to make a lot per hour. And I would say that tuning into this community saves me hours a week to be smart. My belief is that the best loan officers in America need to be able to say, my advice makes a difference. And it needs to be obviously true. That means you need to be a mortgage coach. You need to deliver numbers in a way that's more intelligent than your competition. And you just need to be smarter about the markets. So Dan, if you could stop sharing your screen, guys, there will be a link down below. I hope everybody in the mortgage coach community becomes a customer of yours one day, someday. And with that said, Clayton, I think you guys had a killer back and forth conversation, but I know you had a couple different stories and topics to talk about, knowing that we've only got a few minutes left. Yep. Which topic do you want to jump on first?
Well, Dave, I appreciate the time, and I love the back and forth with Dan. Before I break into this LLPA fee, I only have 2 or 3 minutes here, but Dan, can
we got 5 minutes. Let's go a few minutes late. We can go a few minutes late.
Can we give the people what they came for? Can you go back on that interest rate projection and talk? Give me like a 30-second soundbite on what you're forecasting and over the timeline that we anticipate rates staying in the range that we're in today. And I caught your comment of anticipate getting a lot busier, but I'm curious on the quantification of that.
Yeah, thank you for asking me to clarify that. I did sort of speed up when it mattered.
Show the slide, Dan. If you could pull up the slide so people can take a screenshot. Remember, guys, I'm going to put the slides in here. And then remember, guys, refis can become listings if you're doing more than just a refi. And refis are a great opportunity to build a client for life. And that means you're going to have a lot more refi conversations. You need to get good at it. I'll tell you when I see the slide, Dan.
So I don't have a PowerPoint slide of the projection of interest rates, but what I can show you is what's happening and where I think we're going, and I'll answer it in absolute terms. Let me share my screen real quick. So number one, I think the Fed is going to have to drive rates to 0 at a minimum. We're close to it on the 10-year, but they're going to drive the entire yield curve to 0. I've breezed through a screen showing you what the 2-month, 3-month, 6-month, 1-year, 10-year, 30-year bonds are going for. Those are all going to go to 0. I'm very convinced of that. And the bigger issue here is the spread between mortgage backs, mortgage rates, and Fed funds rates. It's too high. The historic spread's been about 1.5% between mortgage rates and Fed funds rates, and right now we're closer to 2%. So I believe we're going to see 2% 30-year fixed in the near term. I don't mean 2.5. And keep in mind, guys, if you've been listening to me, when it was 3.25, I said we're going to 2.5, and a lot of people didn't believe me. And there's people out there selling 2.5. Now it's inched up a bit. So I think we're going to see 2s, and I think that's going to be for the indefinite future. I hate to even say this, but we could see 1.5. I mean, if what I'm seeing in the economy comes to fruition, I really think a 1.5, 1.75 30-year fix is very, very realistic going into 2021 and 2022. I think 2021, 2022 are going to be rough on the economy, but phenomenal for housing and mortgage originators. Yeah, let me put this link right here. Somebody's asking for.
Right. So Dan, you went exactly where I thought you would. It's a good kind of tee up for the LLPA conversation, the loan level price adjustment, the FHFA push down on Fannie and Freddie refis about a week ago. It's been the talk of the industry. And by looking at our traffic numbers and traffic sources, this clearly is a topic that has garnered interest outside of the professional audience. So it's not just LOs, executives, and real estate agents that are reading about this. Your borrowers are, the consumers are reading about this. And whether it's at the prompt of their friends and family in the industry, or their reading of the headlines and the mainstream newspapers, they're pretty pissed about it. So it's an important topic to understand and speak to and understand the messaging that we should use as professionals around this. So one of the things Dan mentioned was seeing spreads increase to 1.5% to 2%. So this is the topic. This is the defense of the LLPA from the FHA or from the GSEs. Hey, lenders, y'all are making 1.5 or 150 basis point spreads right now. Give us 50 of that. So that positioning sounds like a little bit of a money grab, not the greatest messaging I would have expected from GSC leadership. That said, okay, kind of makes sense. It's a free market. Let's see how this works. But how does that apply to how we message with our borrowers? So rates are still at historic lows. So coming back to Renee's commentary on zooming out and framing, I as a media exec really want to like kind of move away from this being the main point of conversation with borrowers, because for our borrowers, the rates are still at historic lows. Pricing is extremely beneficial for most borrowers to refi, even in this scenario. That does not mean the industry, the executives and the trade associations won't stop pressing on this LLPA. But I think it's really important for originators to understand the topic, understand exactly how it's impacting pricing on the scenarios that you're running, and then be able to move borrowers away from being scared of this LLPA. What I think is the worst case scenario for borrowers that are pursuing a refi right now is to completely walk away from that process because they're scared of this adjustment and pissed that they might have had a cheaper rate a few weeks ago. Framing is where this is really important. And I'm thrilled that the analysis that Dan's has presented and the coaching that Renee used talked about framing. This is a very important topic to understand your personal framing around, to make sure your borrowers, your consumers, your real estate partners understand exactly how this is impacting them. One of my kind of litmus tests on when this topic or when any topic is hitting the consumer eyes is when my friends outside of the industry start texting me about it. And I'm confident you're hearing from borrowers that asking why refi rates just went up 0.5% or 50 whole basis points. So understanding how that loan level price adjustment actually affects APR is critical, and being ready to talk about that framing in a historical context. So, hey, we're not comparing against where rates were 2 weeks ago. We're not comparing against rates at the end of July. Let's think about the bigger picture here. Where is your rate now? Where would you have refied out a year ago? Where might you refi at in 6 or 12 months? And is the cost savings of waiting for that time worth it? So I'm not going to come in with the exact message on how you frame this today. Everyone's got to figure out their own message, how you use in your market with the price point that you work at. But I'm trying to give some context here to how you should think about framing. And for my plug, which I think couples well with the work that Dan does, I write a newsletter 3 times a week called Lending Life. We try to pull data and analysis from folks like Dan and some of the big tech companies that sit on a lot of data like CoreLogic, and pull that into context and advice to help originators frame messaging. So hope you all will all subscribe to Lending Life. I'll drop a link to our Housing Wire newsletter page down in chat and on Facebook as well. And we'll come back to Dan real quick for a little explanation on this Barclays 20-year index before cutting out.
Thanks. Well, I'll be quick, Dave. So because you asked to put it in context, and Clayton made a good point. Before a borrower cries about what they may have lost, they have to realize where they've come from. This is 2019. Think of this as the price of bonds. And as bond prices go up, interest rates go down. So to November of 19, the price of this particular bond, relates to the 10-year bond, was $112.50. It's now $166. 54 points have been bettered in mortgage rates. This translates to a massive drop in interest rates. And I just remind people, okay, this just happened, but we were here just a few weeks ago. So they always have to look at where they've come from before they realize what they've lost. They haven't lost much at all. They've lost from here to here. And by the way, we're on our way back up to this better price anyway. All you, Dave.
Guys, let's go ahead and stop sharing the screen. So this has been just an awesome call of ideas, information. It'll be live on the Mortgage Coach YouTube channel within an hour. I will start asking some of the loan officers that I'm interviewing and some of the top producers for some of their scripts, like, because rate locks have been such an issue, because the market's volatile, and when you lock in a rate, you want to make sure the client delivers on it. I asked that question of Amber Kovark, and she said, here's 3 minutes on how I lock in interest rates. I'll start getting 3-minute clips on some of the other questions. And guys, I want everybody in the mortgage coach community to be the smartest. And that means you need to follow, and you need to read, and you need to understand what's in Housing Wire. You need to follow Clayton Collins. I wouldn't have invited him here if I didn't think he has an incredible content platform. Dan, even I see it because I follow Market Mentor. I don't think a week goes by where he doesn't take an article that he sees in Housing Wire and say, hey guys, here's a great article that you should forward to your client. I mean, that's part of his platform is telling you what content, giving you charts that you can share. So obviously I think everybody should be a Market Mentor. I saw someone ask, do we have a discount code? Guys, $17 a month. No, there's no discount code. It's as cheap as it can be. The most valuable thing you have is your time. So I appreciate your time. Sorry, went a few minutes over. Todd Brookspan, closing thoughts as a coach for anybody that watched today's call.
Well, closing thoughts are, I'm a member of Dan's stuff. It's awesome. I love reading his newsletter every week. It's video format now, which is super cool, Dan, and he gives you all the slides. So props for that. Definitely Clayton always crushes it, and be subscribed to his stuff. But I think from the coaching perspective, I mean, Dan just dropped the bomb, right? We had him on a few months back when rates were higher, and he said they were going to go down, and guess what? They did. And so I think it's really now when Dan says that's going to happen between now and next year, it's what do you need to do today, right? Dave started this call saying that those of you who are taking action are the ones that he's really excited about in this community, encouraging the rest of you. So I just think you have to get off this call and say, okay, how's my system? How am I doing right now? And what do I need to do differently if I'm going to get busier than I am today? Because most of you think you're running really fast today. And Dan just told you you're going to be busier in the near future all through next year, and you may not be ready for it. So look at what you need to do in your business, and just spend some time this weekend and make sure that you're planning ahead.
Thanks, Todd. Dave, one real quick comment. Two, sorry. Honest, swear, not Clayton's here. Every day, twice a day when I broadcast Market Mentor, the first place I go is housingwire.com. Look it up. I'm a member. I scan for content. I jack the content and I put it on that site. And that's part of the point is I go through probably a dozen different publications a day, some mortgage, some not, and I post that stuff. And then the newsletter, we have 1,500 people paying $24 a month, and you're getting Market Mentor and the newsletter for $17. So there's your discount code. Just buy it.
Love it, love it, love it, guys. So everybody who tuned in, we appreciate you. If you got value from this call, whatever social media you're in, give us a like, share this with your friends. For any managers, you need to have a meeting on this. If you just heard from Dan, who I think he's always right. I've been following the guy for over 15 years. He's been broadcasting live in our community since 2008. And you need to meet up. You need to talk about this. And guys, your number one customer is absolutely the families that you serve, but your team is your number one customer. So make sure you're loving on your team, and make sure you're not waiting for the break and you're waiting for it to get slower. You just need to get better in today's market. So this call is a wrap. Thank you for everybody on the call, and have a great weekend, everybody. Take care.
Thanks, guys. Have fun.
Good weekend. Bye. Take it easy.